If you've ever sold an investment, say a stock, mutual fund, or ETF, for example, you've likely made a capital gain or a capital loss. One makes you money and the other loses you money. You can probably guess which is which by their name. But let's dive in a little deeper and explain just how capital gains and capital losses work and why they matter. First, let's talk capital gains. A capital gain is the profit you make when you sell an investment for more money than you paid for it. Here's an example. Let's say I bought 100 shares in Company X for $5 per share for a total of $500. A few years later, after some successful years in business, the price of Company X's shares rises to $15 per share. I decide to sell my 100 shares for $1,500, and I've made a capital gain of $1,000. Of course, investments aren't guaranteed to rise in value and could just as easily deliver a capital loss. That is when you sell an investment for less than you paid for it. Here's another example. I once again buy 100 shares in Company X for $5 per share for a total of $500. This time, Company X goes through some hard times, and the price of their shares drops quickly to $2.50 per share. I need some money for an unexpected expense and need to sell my shares. By selling my shares at this price, I receive $250, resulting in a capital loss of $250 on my initial $500 investment. Capital gains and losses matter because unless you're holding your investments in a registered account, like say a TFSA, they must be declared on your annual income tax return. In Canada, 50% of your capital gains are taxed as income. So from that $1,500 capital gain in our previous example, $750 is taxed as income. How much income tax you'll pay depends on what tax bracket you fall under. You can also use any capital losses you have to claim against your capital gains to reduce those gains and reduce your taxable amounts. To learn more about capital gains and capital losses, visit our website and follow us on social media to learn more about basic investing.